Fifo and weighted average method.
Hi everyone! In this video, we're going to introduce the cost formulas and then explain it further with examples.
In determining inventory cost, we must keep in mind which inventory items and costs to include or not. Inventories are priced at cost, and there are purchases usually made at different unit cost. If there are various cost prices, which price should be allocated to the inventory on the statement of financial position, and which costs should be changed to cost of goods sold on the income statement. There are three GAAP cost formulas: specific identification, weighted average, and first in, first out, which is also known as FIFO. Under specific identification, items sold and purchased are individually identified. This method is appropriate when goods are not homogeneous or interchangeable. Under weighted average, we must calculate a new average unit cost every time a purchase is made. Lastly, in FIFO, as the name suggests, the first items purchased are the first ones used or sold. Let's take a look at this question. Hull Company's record of transactions concerning Part X for the month of April was as follows. Part A asks us to calculate the inventory at April 30 using FIFO and weighted average method. Assume that perpetual inventory records are kept in units only. Carry unit costs to the nearest cent.
To calculate total inventory available and total units sold, we add the transactions on each of the dates that were either in purchase or sales. For total inventory available, we add the balance on hand of 100, the purchase on April 4th of 400, the purchase on April 11th of 300, the purchase on April 18th of 200, the purchase on April 26th of 600, and finally, the purchase on April 30th of 200 to conclude that there were 1,800 units available for sale. As for sales, we add the sales on April 5th of 300 units, the April 12th sale of 200, the April 27th sale of 800, and the April 28th sale of 150 to reach a total units sold of 1,450. To calculate ending inventory, we deduct 1,450 units sold from the total units available of 1,800. This gives us an ending inventory of 350 units. The first in first out cost formula assigns costs based on the assumption the goods are used in the order in which they are purchased. It assumes that the first items purchased are the first ones used or sold. Therefore, the remaining inventory must come from the most recent purchases. Our ending inventory has a total of 350 units. Firstly, as there were no sales past April 28th, we must take the full cost of the most recent purchase, which is dated April 30th. There were 200 units purchased. Therefore, multiply it by the unit cost of $5.80 to get the total cost of $1,160. Secondly, we still have 150 units left from the April 26 purchases. Therefore, we must multiply these by 150 units by $5.60 to get $840. Finally, we will add the total cost of April 30th and 26th, which is $1,160 plus $840, which adds up to a total sum of $2,000. With that said, the amount $2,000 is our total ending inventory cost.
As mentioned earlier, a new average unit cost is determined every time a purchase is made. The weighted average cost method is used to assign the average cost of production to a product. In this question, we assume that a perpetual inventory system is used. When using weighted average method in a perpetual system, a new average unit cost is calculated only after each new purchase, and sales do not affect the average unit cost. To determine the average cost per unit, Let's begin with calculating the total goods available for sale and its total cost during the month of April. We get the total cost of each purchases by multiplying the number of units and their unit cost. The total units of goods available for sale totaled 1,800 and it cost 9,720. Moving on to calculating the average cost per unit, we take the total cost, which is 9,720, and divide it by the total units available for sale, which is 1,800. This gives us an average cost of $5.40 per unit. Earlier, we calculated the ending inventory. After the sale of 1,450 units, we are left with 350 units in inventory. To calculate the cost of inventory on April 30th, we multiply the ending inventory units by the average cost per unit that we calculated earlier, which is $5.40. This gives us the sum of 1,890.
If the perpetual inventory record is kept in dollars and costs are calculated at the time of each withdrawal, what amount would be shown as ending inventory in 1 and 2 above? Carry average unit cost to 4 decimal places.
For the first in and first out, under both periodic and perpetual method, the ending inventory is the same, which is $2,000. This is because the first cost for the period is always the first cost, regardless of when the assignment to expense is made. Thus, the resulting amounts will be the same using either Fifo system. Therefore, companies can maintain the perpetual system to track the units on hand throughout the period but ignore the costs. But when financial statements are to be prepared, they can use the periodic system to compute the cost of ending inventory in order to compute the cost of goods sold. This will help the company monitor their inventories daily without the expense of identifying the costs associated with each new sale. Under the average cost method in perpetual inventory system, the inventory value is determined on the basis of average cost per unit available for sale. We get the average cost per unit by dividing the cost of total inventory available for sale by the number of units available for sale. The cost of total inventory available for sale is equal to the beginning inventory value plus the purchases. In the problem, we get the value of the cost available for sale by adding the inventory on April 1, which is 100 units, times the $5 unit cost, and we add the purchase on April 4, which is 400 units times 510. So we add $500 and 2,040, which is 2,540, divided by the total units available for sale, which is 500. So we get the average cost per unit, which is $5.08. Since the recording of inventories is done as a related transaction of inventories occur, for example, we record the increase of inventories as we purchase them, and at the same time, we record the decrease of inventories as they are sold. For this, the new average cost per unit is calculated every time new batch of inventory is purchased.
Therefore, the ending inventory is 1,977.32 under the average cost perpetual method.